Hey, my name is Rajesh. I am a direct lender based in Los Angeles, California, and I specialize in 2 to 8 unit multifamily buildings. Today we're going to be looking at 1922 Locust Avenue, Long Beach, California, and it costs $1.7 million. It's been on the market for 6 months, so you might be able to get it at a discount. Let's see here, purchase price $1.7 million. Actually, let's run it on our DSCR calculator for a quick, to see if it qualifies really quickly, figure out what we need to do, minimum down payment, etc. So let's see, does this have any vacant units? Pro forma, Class B building. 3 vacant units. This would be a deal breaker both for the bank side and the DSCR side. So this is why I didn't even bother going through this. With the DSCR loan, the vacancy is a problem. So there you go. On to the next video. No, just kidding. Let's imagine for a second that that unit was filled. So let's see what, and here's the thing that I like about this building, because it's at a 7.32% cap rate with only 5 units filled. 3 units are still sitting empty, and it's still doing $124,000 a year in net operating income. So if you were to fill up the other units, you could get it up to $141,000 on a $1.7 million building, which is pretty good. Pretty good. So let's see what we can do here to figure out what the market rents are. We could obviously use this and divide it by 8 or divided by 5. Let's see what that looks like. 1, 2, 4, 4, 3, 7 divided by 5. That gives us $24,887,000 per unit. If we divide that by 12, this tells us what that each unit is earning on a monthly basis. Now, if we do that in reverse, times 8 times 12, that should give us 144, but it gives us 199. So the pro forma NOI is not telling me the whole story here. So let's figure out what the average rent here is. So we can pretend that we have 6 units filled up. Average rent 11/25. Today's the 12th, I believe. $1,700 a month. Use Zillow for this answer. So let's say $1,700 a month. 1,700 times 6 is 1,002, right? Oh, 1,200. 10,200. So number of vacant units, 2. Let's say 1,700. Now this would be 3,400 because we're summing up the vacant units. We're going to count that at 75% of the 3,400, just in case. Property taxes and landlord insurance. Property taxes I'm doing at 1.25%, because if property taxes end up being lower, That just means more money stays with the gross rents. And landlord insurance, I'm doing at about $8,800 a year, or $1,100 per unit. 733 times 12 gives you $87.96, or $8,800 a year in insurance. So next thing, let's take a look at the photos also of this place. Nice looking building, at least in the photos. Interiors are remodeled. But I really like the building because it's really compact. But it does look like they're going to have electric bills. It does look like they're going to have gardening bills. And it does look like they're going to be spending a little bit on water. So let's assume, let's see what water on a monthly basis could be. Maybe 25, pretty low. Gas, probably 0. Electric, $80 a month. Closer to 50, I would assume. Trash is going to be a big thing. Property management, probably nothing if you self-manage, but let's assume that you do. Let's assume that you do have a property manager and they're getting 8%. On an 8-unit building, you're probably getting paid. You're probably paying them per door. You're not doing a single family, and you have volume discounts to negotiate with. So let's say $10,200, because you're not paying rent management fees on the vacant unit, times 0.08, so that's $816 a month. Maintenance, I would say 10% of gross rents I guard towards maintenance, but that's really a judgment call. Let's say maintenance costs you $600 a month. Pest control, $180 a month. I've seen that be the standard. Legal, $120 a month. Let's see what that adds up to in a year. $1,400. It's probably closer to $2,500. So let's see what that looks like. $208. Advertising, $120 just to get a new tenant. Not unheard of. That means your net operating income is $8,100. On a DSCR loan, because the cash flow is so high, supposedly you're looking at 8.25% just to hit a minimum DSCR ratio of 1.0 that allows for the minimum down payment, which is 25%. So yeah, you're looking at, for $425,000, you get the benefit of losing $1,400 a month. On a bank loan, you've got to put 33% down just to get a 5.875%, and that gives you a net cash flow of $1,351. But if you go interest only, that's $2,500 a month, and with this DSCR loan, if you take it down to 70, right? Actually, let's just say 1.1. What does it take to get to 1.1? That's 29% down. 29.9. What happened here? 1.1. And keep this at 5.875 as well with the buy down. Keep it interest only, and now you get 400. You got to put a $425,000 down payment down instead of $557,000 down, and your cash flow is $1,800 a month versus the $2,500 a month. But again, you're doing only 25% down versus 33% down. I think you're probably going to do better if you do you want to hit 2,000 even. let's see, minimum you got to put down $452,000. $452,000 versus $557,000. So you got to save $100,000 and hit $2,000 a month cash flow. Now you did have to buy the interest rate down, but buildings like these that have been on the market for 180 days or 6 months, I'm guessing they're not going to complain too much about having to pay for your interest rate buy down. And this would probably be in the neighborhood of 5 to 6 points right there. Let's say it's 5 points, right? So you've got a $1.7 million property minus $425,000. That means you've got a loan amount of 1.275, and times 5%, you get a buy down cost of $64,000. So instead of lowering the price by $64,000, you just say, hey, give me $65,000 in seller credits. So now you have $1.7 million minus 63,750. That means instead of selling the place for $1.7 million, the seller is actually selling it for $1.636 million. Now, on paper, it will still say 1.7, but in reality, this is what the seller would get in cash before paying off his own existing debt. So let's see what this looks like in 30 years. Because all these places have already been, this building has already been remodeled, right? So let's see what that down payment was. It was 73% LTV, so 27% down. And you bought down the interest rate to 5.875%. And we're keeping it interest only, and so we're going to keep it interest only period of 10 years. Your projected ARV is still 1.7 million. It's got 8 units, earning $1,700 a month. Hazard insurance is $8,800 a year. Let's see what it says about legal. What did I say for legal here? $208 a month. Legal is $208. Gas we agreed to 0. Water is $25 and electric is $50. Lawn and snow. Haven't really accounted for that, but let's say maintenance. Let's roll that into maintenance costs. Maintenance here is $1,251. So let's just say gardening is minus $651. So that should bring those numbers down against the maintenance cost, which would just be a flat $600. HOA and trash removal, we agreed to $250 for HOA and trash removal. Pest control was $180. Advertising, what did we say for advertising? $10 a month. So that means your net operating income is $106,000 a year at the end of your first year. Your net cash flow, and that's net operating income minus debt service, you're netting $33,000. This building cash flows almost $3,000 a month based on this calculator. Net income, you get to write off all that precious depreciation and mortgage interest so that you end up with a negative $29,000 or a $29,000 loss. If you were to sell this building, the exit, at the end of your first year, you're actually losing $192,000. End of your second year, you're losing $129,000. By your fifth year, you're up $125,000. 10th year, $833,000. 20th year, you're up $4 million. Your 30th year, you're up $12 million. Total return, total lifetime return, you're looking at $3.489 million. So on a $1.7 million building, after 30 years, after maximizing all your write-offs and cash flow, and again, we're renting this at $1,700. We have not raised rents. In fact, according to this, the NOI is $124, and my NOI is showing $106. So that's with a decrease in rents, right? And this is, again, with only 5 units filled, whereas this had all 8 units filled. So let's assume that let's use their numbers, all right? Let's see what they're saying. 141,655, not the NOI, but the pro forma NOI. 104,655 divided by 8 divided by 12, that's 1475. That doesn't make sense. Yeah, real estate agents gotta do people a favor. You gotta start listing your gross rents here. I know some people do. That's awesome. Thank you. The ones that don't, you gotta start listing it. This is the stuff that investors look at. If you're not listing it, you're just putting the results. They're like, well, how did you get that? How did you get there? What costs are you leaving out? What costs are you including? Let's see if there's an offering memorandum, actually. Yeah, there's no offering memorandum. But assuming these numbers are true, let's assume this is 124. 124, let's assume that. Let's see what it needs, the gross rents need to be to get there. So maybe $2,100 a month for each of the 8 units. That's 138 NOI. So that's too much. Maybe it is $1,900 a month. $1,900, we're at 122. So probably $1,925. And we're at 124 NOI. 124, 437, 124, 388. So somewhere in that neighborhood. Now let's look at the net cash flow on this building. We're looking at $51,000. Let's look at the exit after 30 years. We're looking at $14.5 million. This is a great buy. Hey, if somebody else doesn't buy this first, I'm going to buy it. Because this seems like a really a pretty sweet deal. Let's see what these numbers look like if I use the numbers that I have from the other sheet. So we went with 1925 for gross rents, I believe. 1925 times 8, 15,400 a month. So here's the net operating income on a monthly basis. 757 times 12, 129, probably a little bit too high here. So let's see here, 1,200 maybe. Let's see what that looks like. 1,157 times 12, 121. So somewhere in there, right? 10257 times 12, 123. We'll leave it at that. So let's see what this looks like. In both cases, you're able to put 25% down. Same interest rate, interest only. Here you would need buyer credits to get that interest rate, or seller credits to get that interest rate. Here it does the standard interest rate, and you're cash flowing $4,000 a month. I don't know why this building has not sold yet. It must be the area, because you can see bars on the window. Nothing says security like safety bars on a window. But this is exactly what would make this property work, even without raising any of the rents, just staying at the $1,900 market rent. Hell, you were cash flowing even at $1,725 a month. So this one seems like a really smart buy.